You've been told interest rates are set by central banks. For a huge share of the loans, mortgages, and derivatives contracts written between the 1980s and the early 2020s, that isn't what actually happened. For decades, the reference rate underneath trillions of dollars in financial contracts was not a market price. It was a number produced once a day by a small panel of banks, based on a question that had almost nothing to do with a real transaction. That number was called LIBOR, the London Interbank Offered Rate. And for a period of years, the people submitting the inputs that built that number were, in some cases, the same people whose trading profits depended on which direction it moved. The official explanation when this became public in 2012 focused on individual wrongdoing, a handful of traders, a few disgraced banks, some embarrassing chat logs. That explanation describes the scandal. The mechanism sits somewhere else entirely, and it tells you something durable about how financial infrastructure gets built, who gets to build it, and what happens when the people measuring a price are also the people betting on it. You assume a benchmark interest rate is calculated the way a thermometer measures temperature, an instrument reading an external reality. LIBOR was closer to a survey. Every business day, a panel of roughly 16 to 18 major banks answered a single question, posed by the British Bankers Association. At what rate could you borrow funds from another bank in reasonable market size just before 11 in the morning London time? Not what rate you did borrow at. What rate you believed you could borrow at hypothetically if asked. That distinction is the entire structural weakness. LIBOR was not built from a transaction record. It was built. You are one of those people if you held a variable rate loan, a private student loan, or a corporate bond fund anywhere in that window. You didn't need to know LIBOR existed. LIBOR still moved money in and out of your account. Picture a derivatives desk in London sometime in the mid-2000s. A trader holds a large book of interest rate swaps, contracts whose payoff depends directly on where LIBOR sets for a specific currency on a specific date. The trader does not control LIBOR. But down the hall, or sometimes at the very next desk, sits the employee responsible for submitting that bank's daily LIBOR estimate. The submission itself was, within a defined range, a judgment call. A submitter could reasonably estimate a slightly higher or slightly lower borrowing cost, and still stay within what looked like a defensible answer to the question being asked. That gap, the space between the lowest plausible honest estimate and the highest plausible honest estimate, was not large in any single day. But it was large enough, multiplied across a trading book worth hundreds of millions of dollars in notional value, to matter enormously to the person holding the position. You watch a request move across a chat window. A trader asks a submitter in casual language to keep the rate low today or high, phrased as a favor between colleagues rather than a formal instruction. You see the submitter adjust the daily figure by a fraction of a basis point, nothing that would draw attention on its own, nothing that appeared in isolation like an anomaly. But the more important mechanism is this: the fraction of a basis point wasn't random noise. It was directional, and it lined up day after day with the trading positions of the people making the requests. Individually invisible, collectively a patterns. The financial press narrative around LIBOR treats 2012 as the moment the world found out. Financial history suggests the warning signs were both public and specific years earlier, and largely set aside. In May 2008, the Wall Street Journal published analysis arguing that several LIBOR panel banks appeared to be reporting borrowing costs lower than what credit default swap markets implied those banks should have been paying. The paper was careful. Its authors acknowledged the analysis did not prove manipulation. But it raised a specific, falsifiable question about the gap between what banks said they could borrow at and what independent market pricing said they should have been paying. That same year, the economist Rosa Abrantz-Metz, alongside co-authors Michael Creighton, Albert Metz, and Gim Seo, began a formal statistical study of LIBOR submission patterns, later published in the Journal of Banking and Finance in 2012 under the title LIBOR Manipulation. Their method borrowed from cartel detection economics, the same statistical screens used to flag bid rigging in unrelated industries, applied here to a benchmark rate. Their central finding: individual bank quotes showed patterns inconsistent with independent, arm's-length estimation, particularly around August 2007, when interbank lending conditions were tightening sharply during the early stage of the global financial crisis. Here is what that pattern historically produced elsewhere before LIBOR. Charles Kindleberger in Manias, Panics, and Crashes 1978 documents how price-setting mechanisms that depend on the self-interested testimony of market participants, rather than observable transactions, have repeatedly proven vulnerable to quiet coordination, precisely because no single actor's contribution looks large enough on its own to justify scrutiny. The LIBOR panel fit that description almost exactly. 18 submitters, each nudging a number by a fraction, none individually accountable for the aggregate outcome. By the time enforcement actions arrived, the picture regulators assembled went well beyond a handful of individuals. Barclays settled with UK and US authorities in June 2012, paying roughly $450 million. UBS followed in December 2012 with a settlement near $1.5 billion. At the time, one of the largest regulatory penalties in banking history. Royal Bank of Scotland settled in February 2013. Deutsche Bank's 2015 settlement, at roughly $2.5 billion, remains among the largest LIBOR-related penalties assessed against a single institution. Collectively, more than a dozen banks and brokers paid regulatory fines totaling several $billion across US, UK, and European authorities. A basis point on a single interest rate swap held by an institutional client could represent a change in value measured in the tens of thousands of dollars. Multiply that basis point across a bank's entire swaps book, and internal estimates cited in regulatory settlement documents described potential trading gains in the millions on any individual well-timed submission. The submission process itself required no supporting transaction record at any point before 2013. A submitter could answer the survey question from judgment alone, with no obligation to show the underlying trade that justified the number. At the peak of LIBOR's use, an estimated 10 million adjustable-rate mortgages in the United States alone referenced the rate directly or indirectly, according to industry estimates cited by U.S. regulators during the transition process. In August 2015, Tom Hayes, a former derivatives trader who had worked at UBS and Citigroup in Tokyo, became the first person convicted at trial for LIBOR-related conduct. A UK jury found him guilty on 8 counts of conspiracy to defraud, and he was sentenced to 14 years in prison, later reduced to 11 on appeal. He served roughly 5.5 years before release in January 2021. Hayes became, in press coverage, the face of the scandal, a specific, named individual standing in for a practice that involved dozens of people across multiple institutions. That framing matters because it shows you something about how financial scandals get processed publicly. A systemic, structural vulnerability gets compressed into a story about one person's choices, which is easier to tell and easier to prosecute, even when the underlying incentive structure implicated an entire market design. Here is where the story becomes more complicated and more useful rather than less. In July 2025, the UK Supreme Court unanimously quashed both Hayes' conviction and that of former Barclays trader Carlo Palombo, who had been convicted in 2019 over Euribor, the euro-denominated equivalent benchmark. The court's reasoning was narrow and specifically legal. The original trial judges had directed juries that any submission influenced by a bank's or trader's commercial interest was automatically dishonest as a matter. Reality, the Supreme Court's ruling was about a specific legal instruction given to a jury a decade earlier, not a factual re-examination of whether submissions were manipulated across the industry. Why it's false? The same ruling explicitly stated there had been ample evidence for a properly instructed jury to convict, and it did not disturb the multi-billion-dollar regulatory findings against the banks themselves, which rested on internal communications rather than the specific legal question at issue in Hayes' criminal trial. Here is the pattern you've likely already half noticed, even without the LIBOR details. The people responsible for reporting a number are inside.